All right, welcome back to the channel, everybody, and I want to thank you all for tuning in. As always, guys, support your local credit union. You know, these are the people who donate stuff like tennis courts, or actually these are pickleball courts. I said tennis courts, but you know, Scott Credit Union is a great company, and they've done all kinds of like great community work. I used to work there actually, and the only reason I quit is because they didn't pay enough. But beyond that, they're a great company. And they really care about their members, right? I mean, they're not customers, they're members, okay? And you are a shareholder, okay? So you need to think about these things. Now, so when you're looking at what we're talking about today is why JEPQ, JEPI, and other ETFs, if you're a shareholder in these ETFs, why these companies might not be the best, and why you might be making a huge mistake investing in these ETFs, and why these ETFs might even be complete garbage. Okay, so we're going to cover it all today. But the point is, like, first of all, these ETFs or these exchange traded funds, for those of you guys who are new to investing, I always forget that not everybody who views my videos are are seasoned investors. A lot of people are new to the investing landscape, and so an exchange traded fund basically diversifies your portfolio. By diversification, I mean you're investing in multiple different individual stocks or securities, which are individual companies that you can take part ownership in. And you can not only take part ownership in one company, but let's say 10 or 20 companies. And in addition to that, you can earn money on things called derivatives such as options. And these options can potentially yield high returns, even 7, 10, 12%, if not more. And so when you're looking at this, just remember that options, derivatives, and the ultimate underlying asset, such as the individual stock, are fantastic measures of shareholder wealth over the long term, right? So we want to think about this from the perspective of ownership. So if you're owning these ETFs, JEPQ, JEPI, and all these ETFs, first of all, one of the major things you're going to experience is a loss of inflation purchasing power. I will repeat, one thing you're going to experience with these ETFs long term is the loss of inflation purchasing power. Now, we would like to believe in a perfect world that these ETFs that we're investing in, these cash flow ETFs, which I've discussed on the channel so many times, and I strongly encourage you, if you're new to the channel, to check out my other videos, because I have a lot of videos on ETFs such as JEPQ, JEPI, the JP Morgan NASDAQ Premium Income ETF, and the JEPI ETF. Both of these ETFs are fantastic, and I love them. But your long-term inflation exposure is significant. It's a big risk, okay? And what I always talk about on my other channel, Multi-Bagger Investing especially, is because we're investing in smaller cap stocks. We're not investing in just these, dividend stocks that are more stable and have a higher return. We're investing in stocks that have a lot more risk. And when it comes to risk, guys, keep in mind, whether you're investing in an individual stock or you're investing in an ETF such as JEPQ, there's still going to be risk. The question is, what type of risk are you taking? And is that risk worth the potential reward that you might receive for, taking said risk? And with that being said, okay, we have to think about JEPQ, JEPI, and all these ETFs 10 years from now and where they might be with inflation. Now, I mentioned that maybe inflation comes down and maybe there's not as much fear about inflation over the next 10 years as people think. There's always so much fear in the market, always so much fear in the news. What if the expectations are not what people seem to be over the long term? Okay, so that's the question you have to ask, because these probabilities do exist. And if that ends up happening, then maybe an ETF like JEPQ and JEPI turns out to be a fantastic long-term investment, because not only are you going to get increasing dividends over the long term, but you're additionally going to get increasing share price, assuming the NASDAQ and the S&P continue to do well, and we see a pretty good boom over the next 5 or 10 years. Perhaps that does in fact happen. You know, we've seen a lot of down markets. A lot of them are very brief, but even in a down market, these ETFs are expected to yield more. But the problem is, if we get a lot of inflation, that's going to be very bad for these ETFs. It already has been, because the total return of these ETFs has not kept up quite as much, I don't think, as the inflation rate. And so as you're looking at the inflation rate, just remember that the inflation rate might be actually higher than these ETFs, and that's a major risk that you have to consider. Now, the second thing is something called NAV erosion. And I want to thank whoever it was who pointed this out in the comments, because there was somebody out there, and I do forget your username. I'll have to look up which comment it was. I get a lot of comments on some of my videos. Some of them are legit, and some of them are robot generated. Got these birds singing out here, man. These birds are having a great time. But it's a Sunday, right? Let them enjoy. God's creation is having a good time out here. I mean, you know, this is fantastic. But the point is, guys, when we're looking at this from the perspective of we have expense ratios. What are expense ratios? Expense ratios are fees that you pay to own the ETF. And if you don't pay them, well, you're not owning the ETF because they're automatically deducted, right? So you're automatically going to have these fees deducted from your total return. And there's nothing you can do about it. So if you have a 65 basis point expense ratio, that is the equivalent, or the fraction equivalent, of 65 100ths of a percent. 65 basis points is all it takes, guys. And that fee over 5 years on top of your inflation risk can result in substantial fees and returns being lost. I mean, 65 basis points, and this is without compounding, by the way, over 5 years is what? 65 times 5, do the math. It's well over 300 basis points, okay? So do we want that? Do we want 3% lost just due to fees on top of inflation risk? If the market's performing at 20% and we can only get 5% because of the way our ETF is structured towards yield versus growth, is that not a problem? And one thing we've seen with QYLD is that QYLD will oftentimes get that 15% yield on an outlier, but typically 11%, 12% is the standard. It has been since existence. But what's the share price at right now? And what was the initial NAV when the ETF was founded? Ask yourself that question. What's the initial NAV for JEPQ and JEPI? What was and what is the initial NAV? Is the net asset value higher or lower than when the ETF came out? These are all questions to ask yourself. And if you ask yourself these questions, I think there's going to be a much better chance of you being able to make money from these ETFs. And if you're actually researching them, diversifying them appropriately across your portfolio, because they don't have to be everything. You know, you don't have to put all your eggs in one basket. You know, you have a $500,000 portfolio, you can diversify into real estate, like that house in the background. Very nice, beautiful home. Probably a lot more than $500,000, I'm guessing, in today's economy. But at the same time, you can diversify real estate, stocks, bonds. They're all out there. So you can still invest in these ETFs, but maybe you should diversify to defend against some of these risks we've talked about, the inflation risk, the net asset value. Overall, there's also the taxation risk, and taxation can occur in a number of ways. First of all, let's say you have a tax deferred account. You start withdrawing money in retirement, you're now paying taxes. Now, if it's tax-free like a Roth IRA, you're still having to wait till 59 and a half to withdraw that fund, the money, right? The funds in the Roth IRA, and you have to have a Roth IRA for 5 years to withdraw without any kind of penalties. So this is a problem, because if you want to retire right now, that might not be possible because of the way the laws are structured in the US, if that's the case, if you live in the US. So depending on your country and depending on your laws, that's another barrier that can really occur when it comes to thinking about cash flow, retirement, and inflation fees, all that kind of stuff ties into taxes as well, because taxes ultimately and regulations are ultimately going to lower your rate of return, right? So think about which country you live in. Think about how much in taxes you pay depending on what account you have in. I mentioned the US. I mentioned the fact that you're going to owe taxes if you take out a retirement account early, 10% penalty plus individual personal income taxes on whatever the income is. You also have the traditional IRA. The traditional IRA, you're still going to owe taxes on even in retirement. And the Roth IRA is the best solution, but even then you can't withdraw till you're 60. So what's the better solution? What's the better solution? I don't know. Let me know what you guys think in the comments down below. But that's another major risk with these ETFs. Where do you have it invested? The other alternative is a taxable brokerage account. And you can do this, but you're going to pay individual income on whatever dividends you receive, assuming they're not qualified. If the dividends are not qualified dividends, you're not going to pay all that much on those dividends, right? Or you're going to pay a lot more than if they were qualified dividends. I'm saying if they were qualified dividends, you would not pay nearly as much, but that's a problem. And so you have to think about these things because your return is going to be significantly impacted by these factors when you invest in these ETFs. Now, with that being said, you guys know I've talked about these ETFs on the channel many times. I love these exchange traded funds. There's nothing against these ETFs at all. I highly recommend them for retirement. I highly recommend them for folks who are trying to retire on less, who want to retire. Even if you're in an RV and you're watching this and you're watching this from the cheapest, source of land or whatever it is you can find to try to retire from an ETF like this, like JEPQ or JEPI, I commend you, right? Because you're trying to retire on less and you might not need that multi-million-dollar mansion like we see in the background here, wherever it is. There it is, right? You might not need the, that's the house, but there's all kinds of nice houses in the background. Now, I'm just saying, work with what you have. Think about your long-term retirement goals, your long-term freedom goals. Think about what housing looks like, because housing is going to be your most significant expense. And with that being said, I'm not saying you have to live in a hut or be homeless or anything, but with that being said, think about what your long-term goals are and what you want to achieve. And with that being said, guys, thank you so much for tuning into this video. These are some of the things that I've talked about with JEPQ, JEPI, all these ETFs out there that are for retirement. And I want to thank you all for tuning into this video. God bless America. God bless you all for tuning into the end of this video. It's a beautiful Sunday. If you're in the Midwest area, it's a beautiful day. So get out there, enjoy life, right? Enjoy the sunshine and everything else, because it is a very nice day out there. So I want to thank you all for tuning in. And with that being said, we will see you all in the next video. Take care out there.